Good day everyone. Floating rate funds are a category of fixed income funds where minimum 65% of assets under management or AUM has to be invested in floating rate securities. Within the category of floating rate securities, the fund can invest in a plain vanilla floating rate security or floater as it's called, or the fund can also create a synthetic floater in case a floating rate security is not available. A floating rate security is a debt security where the interest payment gets adjusted periodically based on a pre-agreed benchmark. The benchmark could be itself a fixed rate security such as a T-bill or a government bond, or it could be based upon an index such as inflation index or an overnight index like MIBOR. To give an example, let's say a bank A issues a 1-year CD at MIBOR plus 50 basis. The investor in that CD gets everyday MIBOR plus a 50 basis spread. So hence, in case the MIBOR rate goes up, the interest which is getting accrued to the investor in this case also keeps on going up. In case the MIBOR rate falls down, the interest which is accrued on the security also starts to go down. So a synthetic floater is a security where an investor takes a position in a fixed rate instrument and then enters into a swap position against it to convert the fixed rate nature of the security into a floating rate. An overnight index swap is a hedging contract between two parties where one party agrees to pay a fixed rate of interest to their counterparty in lieu of the other counterparty receiving the floating leg reference to an overnight rate which is compounded on a daily basis. In simple words, if a counterparty A, for example, has agreed to pay a 1-year swap at a rate of 4% and receive daily MIBOR, what it essentially means is that counterparty is paying 4% interest rate on that 1-year instrument on a notional value, and the counterparty B, who has agreed to receive that swap at 4%, will be paying a daily MIBOR. Essentially what the counterparty A is expecting is a rise in interest rates, and that's why is willing to pay a fixed rate of 4% in this example to receive MIBOR on the expectations that the MIBOR rate will increase. Whereas on the other hand, the counterparty B, who's agreed to receive the fixed rate swap at 4%, expects that interest rates may remain stable or they might even go down, and that's why they are willing to undertake that risk of receiving a fixed rate swap at 4%. So hence, again, to put it in other ways, when investor decides to pay a fixed rate, essentially they are betting on interest rates going up, and when an investor agrees to receive a swap position, they are expecting interest rates to remain stable or to go down. Let's say, as an investor, I have invested in a 2-year fixed rate bond, let's say at 5%, and I want to convert it into a floating rate bond. What I can do is I can pay a 2-year swap, for example, at a rate of 430 and receive daily MIBOR. So how I can convert this 2-year bond into a floating rate is, in this transaction, for example, I'm receiving 5% coupon on my 2-year bond. I'm paying a fixed rate of 4.3% to my swap counterparty, in return of which the swap counterparty is paying me daily MIBOR. So my 2-year bond, from becoming 5%, becomes a MIBOR plus 70 basis point, which is basically 5% the coupon I receive from the bond, the 430 interest I pay to the swap counterparty, and the daily MIBOR I receive. So this is how typically synthetic floaters are created from fixed rate securities. It's a common myth sometimes that floating rate interest securities might remain unaffected during the rising rate scenario. Yes, it is true that the coupon of the security gets readjusted in case of rising interest rates, but the duration impact of the security is still gets impacted on the mark-to-market component. For example, if you have a 2-year floating rate security and you have a 5-year floating rate security, the coupon will be adjusted in both cases, but the mark-to-market losses could be seen higher in the 5-year bond compared to, let's say, a 2-year security that the investor could be holding. To give you a example, so let's say if you're holding a 1-year CD at a MIBOR plus some spread, let's say in this example it's MIBOR plus 50 basis. Let's say in case of rising interest rates, how the mark-to-market component works is that the spread of the security gets adjusted. So while you might get higher interest rate on the security, but because of the change in spread, that particular security could start to trade in discount or higher discount, which could result in mark-to-market volatility to even a floating rate portfolio in a period of rising interest rate. The second point to be considered, especially in case of synthetic floaters, is synthetic floaters contain a basis risk embedded in them, and I'll explain with the help of an example. So let's say you are holding a 3-year bond against which you have entered into a 1-year paid OIS position to make it into a synthetic floater. So what happens, let's say interest rate rises by 10 basis points in your bond portfolio. Firstly, it's not certain that your swap position will also rise by 10 basis, or it may even rise at all. Even if it rises by 10 basis points, the portfolio is still impacted by the net 2-year duration that you were holding. That is, you were holding a 3-year bond against which you had paid a 1-year swap to create a synthetic floater. So you were still exposed to a 2-year net duration. So I think ultimately investors should look at the net duration of the portfolio to assess the mark-to-market risk they can be impacted during the changing rates.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.